Hello and welcome to Thank God It's Friday. We are in conversation this week with Abhay Laijawala. He is the Managing Director and Head of Research of Deutsche Bank. Abhay, thank you for joining us this week.
Thank you for having me.
Well, as usual, once again, we have to start with the Trump administration. Now, we've been given some indication of what the administration's intent is with respect to trade. And based on that, there is a lot of flip-flop. We have seen the dollar strengthen to quite an extent, of course, barring the last 10 odd days. What is your outlook on the dollar? And based on that, what is your outlook on flows?
Right. So we are extremely positive on US economic growth. Our sense is that US economic growth will exceed 3 to 3.5% this year. And on the back of the economy was already on the back of a strong tailwind, which probably will get even stronger as a result of the many articulated policies of President Trump. And here I'm primarily referring to the tax cuts, I'm referring to the deregulation that he's promised, coupled with the possibility of a fiscal stimulus.
Right.
So I guess as and when the articulation of the economic plan takes place, including the tax cuts, we probably may see a resumption in the movement of the dollar. So you've seen the DXY over the last couple of weeks has come off from 105 to 100 odd. One would think that as he articulates his economic plan, it's likely that the DXY will start to appreciate once again.
Right.
And again, we've seen that with the DXY having come off from the 105 to 100, we saw some sort of return to emerging market inflows. Right. Probably you may see with the dollar strengthening, with the expectations of these policies buoying up US bond yields, we may see flows start to dry up once again.
Okay.
Moving back to India then, we have the state elections coming up in March, and of course that could be a test of sorts for the Prime Minister after the disruptive cash ban. What could the potential outcomes really mean in terms of political risks and implications for the market? Do you think this is going to be used as an opportunity to probably just take some profits off the table?
So that may probably happen. We still do not know the outcome. The opinion polls seem to be suggesting that the BJP has a very good chance, though some opinion polls are also suggesting that it's a closed fight. But you know what? Let's look back. Let's see what happened in Bihar. In Bihar too, everyone was of the view that if the BJP loses, the markets will come off. The markets will worry that the Prime Minister is, losing the support of the people, etc., etc. But nothing of that sort happened. I think investors will realize that there are state elections and there is a national election. And even if the ruling party is not winning in the state, that doesn't necessarily mean that they do not have a chance to come back to power in the national election, because there are state level issues. And this is a state election. So my sense is that the market, even if the market is disappointed in the event of an outcome where the BJP is not doing well, it will be short-lived. It should not be an indication that popularity levels are going down. In fact, I don't know if you all are aware, there was a poll recently, I believe it was India Today. This is the Mood of the Nation poll.
Right.
And in the Mood of the Nation poll, it did show that the Prime Minister's popularity rankings are at an all-time high.
Right.
So I would imagine that, with all of that, his popularity remains intact. And I guess there is, at this point in time, no risk in terms of them forming the next government.
So we could conclude that irrespective of the outcome of these state elections, it may not be of great significance to the markets in general.
That's right. But we have to also realize what levels the markets are at. So given that the markets have moved up so much, the market probably could use this as an excuse, to take some, investors could use this as an excuse to take some money off the table.
Right.
Because we've seen a literal one-way rise in the market in the last couple of weeks, fueled by domestic liquidity.
And now the GST isn't too far away either, and of course that's going to create some negative implications for the economy. Abhay, how do you really think it could impact FY18 earnings? And again, does that mean that we could probably see that double-digit sort of earnings growth getting pushed back yet again by yet another year?
I think that's a very safe assumption. I guess that looks very, very likely. Currently, consensus estimates for FY18 are at around 20 to 22% earnings growth for FY18. Now, with the GST, there will be disruption, and therefore we will probably see scale back or downgrade to consensus earnings. So how much they go down, I guess that the jury is not yet in. We will have to see what the modalities of the GST are, what the rates of GST are, what are the GST rates on the different areas within services, etc. So it's difficult to take a call on what would be the scale of the earnings cuts, but nonetheless, consensus earnings will be cut in the second half of the year.
Right. Well, we just have the RBI policy right now as well, and their stance has changed to neutral from accommodative. So, and the commentary seemed relatively hawkish. Are you concerned? And based on that, how are you viewing the interest rate trajectory going forward and implications on the markets?
So, for whatever it's worth, when we'd written our outlook for this year, we had said in that outlook that monetary policy accommodation in India is coming to a close.
Right.
We were obviously not so sure of the timing, and we hadn't really expected it to happen in January, February itself.
Right.
But we were also of the view that it was likely that at best there could have been just one more rate cut, which would have led to a 200 basis point total cut in the repo over this cycle. Right. So honestly, with what's happening in the US, with the return of inflation, with Chinese fixed asset investment moving up, with the deflators all over the world moving up, and commodity prices led by commodity prices, I think this writing was on the wall. Right. Our view was, however, that we could probably see the transfer of the baton from monetary policy to fiscal policy. But even that did not come through, because the government has focused on fiscal consolidation, which is very, very good. I think this is something that the world will notice. But this does mean that clearly, the scope for a GDP expansion or a return back to the 8% in the next 12 months looks difficult.
Right.
So what does this end of the easing cycle really mean for interest rate sensitives going ahead?
So look, liquidity is abundant. True. Right? And just because policy rates are not going to be cut further doesn't necessarily mean that the banks cannot still cut rates more. In fact, with the banks sitting on almost a 12% above SLR, they're sitting on a 32% SLR relative to a statutory requirement of 21%. The banks are flush with cash, and therefore probably monetary transmission will probably be the way forward. So I don't think there has been a change to the expectation that interest rates are going to remain low. It may not be the RBI, but it will be the banks who will be doing it.
Okay, further transmission then. But Abhay, within that gamut of listed financial companies, among private banks, PSU banks, housing finance companies, microfinance companies, or consumer lending companies, where is it that you're still seeing some value, or where at least where you're convinced of a recovery from the demonetization hit?
So I think we are at this point in time, a banks analyst believes that wholesale funded banks should be the beneficiaries. So what we are looking out for is two key characteristics in banks. One is banks that are wholesale funded, and the other one is smaller banks, because in an environment of slow loan growth, the market will pay a premium for whoever can grow the fastest. And the smaller the bank, faster the growth. So therefore our preferences are for relatively smaller private sector banks which are wholesale funded. 1 year ago the market would have probably been excited over NIMs, or market would have been excited over asset quality. But with loan growth slowing down to 5%, more than asset quality, the market is now looking at growth.
Right.
All right.
Well, coming down to commodities, we've seen quite a run up in the prices of commodities like iron, aluminium, zinc, and along with that, we've also seen quite a growth in the share prices of a lot of these metal stocks. Is there more upside left, and what is your view on the metal sector?
We remain positive on metals. We like aluminum, we like zinc, and we like steel. And within steel, we think that the government's measures have been very proactive. The measures on initially imposing the minimum import price and now transitioning towards the anti-dumping duty, because this is going to be very important for the domestic steel industry, because in the last 5 years you've seen very significant expansions in the domestic steel industry. Right. But in the last 2 years, up until the government's proactive moves, the domestic producers were not able to sell in the market because imports were coming in from China. Right. And China, other countries, Russia, CIS. They were all putting a lot of steel into India, and therefore the domestic steel producers were not able to even cover their fixed overhead. Right. With what the government has done, domestic sales are back, and I think that is being reflected in the return to normal EBITDA margins and normal EBITDA for many of the domestic steel companies. And we believe that with these proactive measures continuing, we think that these companies will continue to report good numbers over the next couple of quarters. Right. So therefore, I think, and with China maintaining its fixed asset investment, metals remains an attractive place still. So we like aluminum, we like steel.
All right.
Okay. Abhay, why do you? And zinc, all right. Why do you still remain a buyer of consumer staples? I believe you have an overweight there too, because the management commentary in Q3 and even what was reflected in terms of the volume growth numbers, it clearly indicated the demonetization pains. I want to understand how you're picking stocks in this sector. Is it purely valuation based, or probably it's a choice between rural versus urban focus?
No, so the reason why we like staples selectively is because we do believe that the impact of demonetization, once it wears out, the return of rural demand following a very good monsoon last year will come back. Now, I don't know if you all have seen the numbers. All of last year, or up until between the second quarter and the third quarter of last year, FMCG value sales were moving up. Mm-hmm. But in the December quarter, FMCG value sales went to the lowest in terms of year-on-year growth, right, impacted by demonetization. Yes. Our sense is that as the effect of demonetization wears out, as the economy starts to get the cash back into the system, the very drivers that we were all expecting in terms of the return of rural demand will come back. And therefore, on a selective basis, we do like the consumer staples sector, because the rural economy is doing very well, and will do very well, because that's where the government is focusing on.
Right. All right. I just have one more question, which I'm sure you get it all the time, and this is to do with the information technology sector. I know that there is a lot of concern about a possible hit because of H1Bs on their margins, but I was also going through some of the things that you've said, that deregulation in the long run is something that could benefit the information technology. Can you tell us a little more about it?
Sure. So we are contrarian. We've turned positive on IT after having been negative for all of last year. We turned positive in, I believe, November of last year, and we remain very positive. And the reasons are, one of them is deregulation, but I think the biggest reason is, and what everyone seems to be missing out on, is the revenue part of the equation.
Right.
The global banking and financial services sector constitutes close to 40-45% of the revenues of Indian IT companies.
Right.
And, we should not ignore what's happening in the global banking space.
Right.
Interest rates are rising, so yield curves are steepening.
Right.
NIMs will come back, loan growth is beginning to come back, and you have the prospect of lower regulation.
Right.
Trump is already talking about abolishing or working on the Dodd-Frank Act. This is something that the global banking industry has been waiting for. So a lot of the discretionary IT spending, which has been held back, will potentially come back. In fact, our analyst believes that constant currency growth for the IT sector, which was around 5 to 6% last year, can be 10 to 11% in the next fiscal year. And look at valuations. So on a PE relative basis, we do it on MSCI. So if you look at MSCI India IT PE relative to MSCI India, it's trading at valuations you last saw in 2009.
Right.
So you have valuation support, you have catalysts. I agree that the concerns on H1B are legitimate. We do need to worry about that. But if the rupee were to go to a 70 to the dollar, part of those concerns would also get mitigated.
Right.
And if we do believe that as a result of Trump's policies, the DXY is going to appreciate, then I guess the rupee has to depreciate towards a 70. In fact, that's what our economists think will happen by the end of this year. So, contrarian, but don't ignore the IT services sector.
Right, right. And finally, we are looking at a weekend. We'd like you to tell us about an interesting book that you read in the recent times.
I keep buying books and reading parts of them, and my wife keeps complaining that there's just no place to keep these books. So let me recall. I think one that I enjoyed was Mervyn King's book on, I think it was The Alchemy of Global Finance. I think really enjoyed that, and I think I would recommend it to anyone who wants to understand what really happened after the global financial crisis, and particularly what kind of ordeal central bankers had to go through, and what they have done and not done, and what they should do, what they should not do.
Right.
So yeah, that book comes to mind, and I actually picked up a book. It's a biography of Rishi Kapoor. For some very, very light reading, and because anyone who enjoys Bollywood, or at least has grown up in India, and wants to understand what was happening in Bollywood in the 70s and the 80s, I think they should read his book. I enjoyed it.
Right.
All right, that does sound interesting. I'm going to probably
between central bankers on one side and Rishi Kapoor on the other. So,
that's diversity at its best. But Abhay, it was a pleasure talking to you. Thank you so much for joining us. And as for you guys, with that, it's a wrap on today's edition of Thank God It's Friday. Have a good weekend and stay tuned to Bloomberg.